My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the hour is returning champion Keith Weiner. We're going to be talking about a lot of different big topics here. But Keith, introduce yourself to the audience. Who are you? What's your background? How'd you get involved in markets, in metals, and what do you do now?
Founder and CEO of a company called Monetary Metals. We pay interest on gold. I consider myself to be a serial entrepreneur. Founded and built a software company called Diamondware. Sold that to Nortel Networks. August 19 of 2008 was the transaction. So while I was sitting there in 100% cash, just about watching the world go over the edge in the fall of 2008, started to study markets and economics, came to realize there was a very great problem, came to realize that gold had something to do with the solution, wanted my next venture to be part of the solution, founded Monetary Metals a few years later in 2012, and came to realize that interest is the key to the whole thing. Interest is what will cause gold to circulate and restart the gold standard that President Roosevelt killed in 1933.
So you mentioned you were staring over the edge in 2008. I wonder if you think that we're maybe staring at a similar type of moment. You got this regional bank crisis, you get the debt ceiling, you got a hell of a lot of complacency, you've got commercial real estate, housing maybe being a problem. Are there any parallels to how you felt then with how you feel now?
It's, we're leaving aside the debt ceiling, which I think is a big nothing burger, and I think it's just an opportunity for the two parties to, engage in some grandstanding and some posturing. But we're in exactly the same place that we're in 2008. Only, everyone uses the expression kicking the can down the road. Well, we're farther down the road and the can has more kicks in it, right? So it's the same mess. What did they do? I mean, it was a crisis of too much debt. So what did they do? Lower the interest rate and, create even more debt. And the last crisis was precipitated when the Fed thought that it could hike interest rates. And so now we're staring at the next crisis because the Fed thinks it can hike interest rates. And absolutely, I see a lot of parallels, except things are bigger and more severe now than they were in 2008.
I guess the question is what can be done about it. I mean, I remember in 2008, I think it was Jim Grant who said, we've been kicking the can down the road so much the can's kicking back, right, was sort of his argument back then. And I think there is some truth to that, right? I mean, the can kicking back now is inflation, right? That there's a cost to, everything that the government's done and the Fed has done. But that doesn't mean that you have to absolutely collapse tomorrow. I mean, this is a process in terms of that backdrop. So how do you think through, again, given that you've done very well for yourself with your portfolios, we'll talk about gold, but how do you think through asset allocation in an environment which is very, very deceptive, tricky, but also could, for a moment in time, rally, just like we see prior to, major crashes in general?
It's really, really hard. And I know that sounds like a cliche, and Yogi Berra, predictions about the future difficult. Predictions are difficult, especially about the future. It's one thing to look at the economics and say there are certain economic laws, there are certain things that work the way they work, and place your bets appropriately. It's another to say, okay, there's a bunch of politicians in charge, and that's what they are. At the end of the day, when you socialize something, and that's what the Fed is, it's the socialization of credit. When you socialize something, it replaces any kind of market process with a political process. And these people posture as economists, but really their intent is to centrally plan, our little lives for us. And you're trying to guess what they're going to do next. And politics makes very strange alliances, bedfellows. There's no question in my mind that the interest rate trend is falling, and all the forces of why it's falling are reasserting themselves with a vengeance. But Powell seems hell-bent on hiking interest rates, at least until there's such a degree of crisis. I like to use the analogy, he's in the ivory tower on the 110th floor, and he can look down 110 floors and he can see all the people down below. And he's like, I do say, James, they do seem to be in a bit of a spot of trouble down there. Look at all that mayhem. And when the flames finally are looking at the windowsill on the 110th floor, oh my God, there's a crisis. They're not particularly sensitive to the crisis until it reaches a certain point. But it becomes very political. And I'll use the example of Silicon Valley Bank. which two groups were most opposed to the bailout of Silicon Valley Bank? And that's what it was. I mean, FDIC has a limit of $250,000, but a couple of days after they seized the bank, the regulators said, we're going to bail out all the deposits, regardless of the size. The two groups that came together in opposition to this were the extreme left and the extreme right. The extreme left opposed it on grounds that they're bailing out rich white people, and the extreme right opposed it on grounds that we're bailing out extreme woke people. And so, apply that to the Fed and its decision to hike or not hike. Which way could the politics twist? Jay Powell, nominally Republican, but now he has to work obviously under a Democrat administration. Which way does he want to go? Which are the political wins? And in order to figure out which assets you want to allocate to, you kind of want to understand if interest rates are going to continue to rise, you certainly wouldn't want exposure to anything that was credit sensitive, such as real estate. If interest rates are going to fall, it might be a good time now to place your bets because, certain things are going to boom in that kind of environment. And it's a political guess. That's not really an economic question. And so, I don't know. That's not one that I feel I have any particular, insight. Eventually, he's going to be forced to cut rates, but it's a question of when.
Yeah, or the market will force them to cut rates, meaning the bond market would move first, right? And the thing is, you got a lot of noise because of the debt ceiling, which we'll get into. But I want to hit on the word crisis. As the whole regional bank stuff was unfolding, I kept on saying, and I still believe this, that it's a bit of a manufactured crisis. Because how do you stimulate in high inflation, right, with an excuse, right? And the excuse being that there's this kind of regional crisis that, let's face it, it's not really impacting the headline averages, but clearly has impacted small caps and certain other kind of cyclical sectors of the stock market. Is this enough of a crisis, in quotes, for the Fed to, you think, change course down the line, given the lag effects, or do you suspect that this is also kind of a nothing burger?
Well, I think there's a very real banking crisis, and the banking crisis is born out of all of the things that people consider to be features, not bugs, in our monetary and banking system. That we have irredeemable currency, which means the interest rate is unstable. Number one, unstable interest means that bond prices move inverse to interest rates. So if interest rates are rising, that means bond prices falling. We have monetary policy, right? So everyone likes to look at Silicon Valley Bank and say, oh, stupid. They bought all these, at the height of the 2020 stimulus, they had a huge inrush of deposits. Their customers, of course, tend to be venture-backed startups, and venture-backed startups are raising huge amounts of money in 2020 and 2021. So they had huge inflow of deposits. They have to buy some sort of asset with that cash. They bought long-dated treasury bonds. And everyone says how stupid they were. Well, let's take a look at what was going on. Number one, monetary policy at that time was to try to drive down the interest rate across the whole yield curve, but especially including long-dated, bonds. So I want to know to what degree were the supervised? So banks aren't just merely regulated, right? If you're in the finance business as an investment advisor or a broker, you have regulation, right? You have to file reports, you have to have a license, there's certain things you have to do. If you're a bank, you're actually supervised. You have to house at your expense government employees in your offices, and those people are inviting themselves into your meetings, reading your emails, going through your records, and telling you what to do. And they have varying degrees of suggest versus nudge versus strongly encourage versus order you what to do. I want to know what degree the regulators and the supervisors were telling them buy long-dated treasury bonds because that was supporting monetary policy at that moment in time. So whatever, they bought long-dated treasury bonds, and a lot of them, and because they had huge inrush of deposits. Fast forward to a rising interest rate environment. Venture-backed companies aren't raising capital anymore. And as these companies are spending their cash balances, you see a net outflow of deposits from Silicon Valley Bank in particular, but all the regionals have the same problem to varying degrees, or all the smaller banks, I should say, including the regionals. And so you have a situation where the bank now has to start selling these assets, these long-dated treasuries, in order to meet the relentless outflow of deposits. Well, now they're selling stuff that they had bought at higher prices, and now they're selling it at lower prices. They're taking dreadful losses, which were kind of a surprise because if you go back to 2008, there were a lot of people who believed that mark-to-market accounting, right, when a bank has an asset that it holds and the asset loses value, the bank would have to mark it down on their balance sheet and show the losses. There were a lot of people who argued in 2008 that that was exacerbating the crisis. In 2009, almost at the day that the market hit its bottom, I want to say it was March or April of 2009, they changed the accounting rules and said you don't have to mark to market anymore. You can keep those things at at par as long as you declare your intention to hold them to maturity. So Silicon Valley Bank had all these bonds held to maturity, quote unquote, which is just a regulatory category. It's not a fact. So you get deposit outflows, and suddenly we have to sell these things that they said hold to maturity, and then the losses are revealed. And if you bought in August of 2020 and you were selling in January of 2023, you were looking at about a 25% loss on some of those bonds, which for a bank is an enormous hole in the balance sheet. People started to become alarmed, and you have acceleration of outflows, and eventually the bank collapses. That same dynamic is occurring in a lot of other banks, and I don't know what amount of dollars, trillions of dollars, I would assume, is at risk, because of this. So what's happened now is money market funds in particular, and Treasury Direct, I would assume as well, are luring people out of bank deposits and into alternative kinds of instruments that are paying a higher interest rate. The banks can't match those interest rates because their asset portfolios don't pay. And so that's just, basically there's a slow motion run on the banks right now. The smaller ones, not the big four, but most of the other guys.
Yeah, we're back to too big to fail, but not for all banks, right? I think is the dynamic. I'm glad you mentioned that point about the mark to market. I remember that period quite well, and I think there is a lot of validity to the idea that removing the mark to market is what caused the con of confidence to come back into markets, right, and kind of create that self-perpetuated low and rally since then. Um, no way to prove it, but do you suspect that if we were back in a mark-to-market kind of world, that this would look even worse than 2008 when you look at the duration side, the way that it cratered last year?
Yeah, I mean, it's hard for me to guess, and I haven't run those numbers, and I guess it would look worse than 2008. But I think more importantly, it would give the bankers themselves, I think everybody tends to focus on whatever the official number is. It's very hard to hold simultaneously in your head, well, for statutory purposes, we're perfectly solvent, and we have, whatever, $15 billion in equity, but really we have, negative equity. We're actually insolvent. Even the bank managers. How do you simultaneously believe those two things? But then certainly for everyone else, investors, depositors, do not have a clear picture of just how bad it is. And of course, the fear of the unknown may actually exacerbate the behavior. Certain banks might be more or less okay. They may have done more to try to hedge the interest rate risk, whatever. That was the other thing. The change in mark-to-market accounting had a very, people talk about unintended consequences. And I don't prefer that term because it puts too much focus on the alleged intentions of the politicians who passed these stupid laws. I'd rather call it perverse incentives, which motivate perverse behaviors and you get perverse outcomes. One of the perverse incentives of the suspension of mark-to-market, if you have a bond and you declare it hold to maturity, you can't hedge it anymore. It's not really possible because the hedge would then be a standalone instrument that in itself would have a mark-to-market implication and create volatility on your earnings. So there was a strong disincentive in that form to not hedge. So anyways, you just get all these things accumulating. It's very opaque because there isn't mark-to-market. It's very hard for people to see, okay, well, what's the real picture? And then what exactly is served if you can't see a clear picture of a bank's balance sheet? What's the whole point of public accounting if you can't see a clear picture? I mean, the whole thing just becomes just a giant mess. And of course, people are acting on fear, which, make it worse. And I think if you made the assumption that the banking system was insolvent you wouldn't, if that turns out not to be true, you wouldn't be very far off the mark. And I suspect that's the reality of where we're at right now. What are the implications of that? Well, they're pretty broad. But
well, I would argue in a very weird way that that's bullish, because it goes back to my point of, the end of the world is the bull case. It's like, if everything's insolvent, nothing fucking matters. So I might as well YOLO into anything and everything else. But I hear you. I mean, it's hard to argue with the fact that, if you were to price things in real time, there actually isn't enough capital in the context of all this inflation.
Yeah, I mean, and I don't frame it as an inflation thing. I frame it as the banks have a balance sheet with assets and liabilities, and when assets fall below liabilities, and assets have fallen a lot in the last, 15 months, assets less than liabilities is the recipe for insolvency. Very simple. So that's a pretty compelling argument if you're Jay Powell, to reverse and start lowering interest rates to get asset prices to come back up, and then the banks can be magically recapitalized, which is a whole other set of problems. I guess I want to say one thing by way of caveat, Michael, for anybody listening to this. Sometimes people may think, well, I'm just an apologist for the system, or I'm just cheering on the dollar and the treasury and the debt and all that. I'm absolutely not. The system is horribly perverse. It's wickedly harmful to everybody. But as you look at the choice of, burn it all down now versus, buy us some more time to hopefully try to get to a better solution, I can't imagine why anybody would say burn it down now.
I'm so glad you said it. This is the shit that drives me crazy about the way that people think. It's like, we all agree we want the system to be fairer and efficient in the allocation of capital. And the response is, well, you got to burn it down for that to be the case. Do you know how painful that's going to be? I mean, it's like, I don't know how people think. You want the system to fix itself, ideally faster than not. But if you're going to do it through an event, I promise you don't want that event to happen in your lifetime.
Yeah, I was going to say, I've written a lot about 476 AD as that sort of event. And sure, absolutely, it's true. We went back to honest gold coinage after 476 AD. Of course, more than 90% of the population perished. And then you had, several centuries of essentially constant open war. My theory of King Arthur is that things were so bad that people were begging desperately for any strongman who would rape them and abuse them and take 50% of their income and draft their sons to the army, as long as he would stop the general killing. And then, finally you have a medieval period, many centuries after Rome collapses, and then a Renaissance, and the world finally got back to Roman levels of engineering and technology, 1,400 years, 1,500 years after, after Rome fell. It's the sort of calamity that, you don't necessarily want to be anywhere near that when that happened.
Speaking about hedges, I think that's a good transition to metals, gold in particular, which, it's kind of hovering around its, kind of high that looks like it was touched a few times, going back to 2020. What's it going to take for gold to really kind of break out and have sort of a real secular cycle? Does it need a catalyst? Does it just need institutional momentum players? What would it take for people to be convinced to play a trend in gold?
Well, first I'll give the short answer, but then, as I'm sure you suspected, I want to add a few more remarks to that. I think when and it's not an if, it's a when Powell reverses and we're going back to ZIRP and beyond, zero interest rate policy, you're going to see a hell of a rally in the gold price. That said, I think we're in a bull market now. I think that the trend of, let's call it post 2011 through 2018, 2019, I think that's done. I think there's just different patterns of behavior in the market, globally. And I don't think we're in that, sell the blip kind of place that we were for so long. I think we're in a buy the dip kind of place. All of that said, I always have to put the caveat around this. I don't think gold actually moves anywhere. It's the dollar that moves down, not gold that moves up. And so what we're really saying is, what's the next secular bear market in the dollar, or what's going to take for the dollar to move down big time from, 15, 16 milligrams of gold to, let's say, 7 milligrams of gold per dollar. What is it going to take? Well, as they continue to erode the soundness of the dollar and confidence in the dollar institutions, it's logical for people to want to dump their dollars more. And that's what the gold trade is. It's when you don't want to invest or speculate in anything else, even including, the generally accepted medium of exchange. When you're just done with that and don't trust it anymore, then gold is the thing to buy. It's the only thing to buy. It's the only thing that is both a financial asset and not the liability of some other counterparty. So there's things that aren't liabilities. You could buy antique cars, you could buy whiskey, you could buy real estate, artwork, but those things they're not financial assets. They have wide bid-ask spreads, and of course they're quite subject to credit conditions. Gold is a financial asset, but it doesn't have those problems. And so it's interesting to me that as unloved as gold is, as it's either not talked about or people dismiss it with an area hand wave, how stupid it is to buy gold. Look at where the price is, near all-time highs in dollar terms, and even stronger in most other currencies.
Speaking about the dollar, sort of a link to that, I'm looking at the thread in the space, and there's a comment saying, has anyone considered that things, in quotes, might have changed? Does anyone consider that over half the world's population is maybe done with the U.S. and the weaponization of the dollar? Now, I will preface this by saying that all the times I've said in the last couple of weeks that I think the dollar is going to make the greatest comeback since Lazarus, that's more of a short-term trading sentiment, not sort of a secular long-term trend argument. But what are your thoughts on sort of just in the context of this idea of this bear market in the dollar, how that interplays with the broader narratives around de-dollarization, which, let's face it, a lot of people talk about it, but I'm a little skeptical myself.
So first, a quick remark about bear market and dollar. It's really, since the highs in the DXY, what was that, 5 months ago now? I'm kind of losing track of that. It's the other currencies going up, not the dollar going down. The other currencies are all dollar derivatives. So it's the other currencies going up against the dollar, which is what's supposed to happen when the Fed becomes more accommodative. That's supposed to be good for everybody. And the way the Fed becomes more accommodative, I had a bit of a discussion. We had Danielle DiMartino Booth on our podcast, The Gold Exchange. And, of course, she very famously said it's not QE, this term bank loan facility, or whatever they call it, in the wake of Silicon Valley Bank. And I said, whether or not you use that label QE is not that interesting to me, but it seems to me that the Fed is take a thing with one hand by, saying we're hiking interest rates and all that, but they give a thing with another. They're lending cash against bank assets, but not at current market value. They're doing it at par, whatever the banks paid for it originally. And so that is providing some critical liquidity to the market. That allows things to rally, or at least not crash the way they otherwise would. The other currencies are rallying. There's nothing to do with, quote unquote, de-dollarization. So I'll offer a couple of thoughts on de-dollarization. One, the other currencies are all dollar derivatives. Even if you look at some particular central bank's balance sheet and see that the quantity of dollars as a percentage went down, and instead they had, whether it's euros or yuan or whatever on it, replacing the dollar with one of its derivatives doesn't fundamentally change anything. It's rearranging the deck chairs on the Titanic. That's the first thing. The second thing is the other currencies have reasons to be even less trusted than the US currency. It's just that there's less data about those other currencies, there's less transparency, and so everyone loves to, the dollar is the favorite punching bag because there's so much more visibility and transparency as to what's going on versus the yuan. On a business trip, I visited mainland China. This was pre-COVID, and obviously I haven't been back since, to see if there was a market there for folks that wanted to obviously get some money outside of the Chinese system, get it into gold rather than dollars, and get a return on their gold or an interest on their gold. And what I discovered there after meeting several wealth advisors is, wealth advisors there do the same thing as they do in the U.S. or Western countries, which is to help people understand their goals and their risk tolerances, risk preferences, and put together allocations that make sense, keep people kind of on the straight and narrow. But in addition to that, they have one I would almost say, overarching function, which is they navigate the ever-changing capital controls. Everybody with any degree of wealth in China is desperately trying to get their capital out of yuan and out of China. And they risk their lives to do so. And there's a whole cottage industry of wealth advisors that help them do that. And so the thought that people are going to send their deposits to China and become a creditor to President Xi, while his own people are risking their lives to escape it, just strikes me as not realistic at best. And then finally, I'll say, in all my travels, I certainly, and I visit a lot of countries where they're not necessarily, certainly not friends of the dollar, not in some cases, not even necessarily friends with the U.S. or not that friendly. Everybody hates it. They realize the dollar is killing them. That's well understood, and that's not news. I mean, that's just been that way for many, many decades. But there's no realistic hope in these parts of the world that there's anything that really replaces the dollar. It's one thing, and it's the way voters talk versus the way they actually behave. People vote for things like light rail. Why? Is that because they intend to actually take light rail and get rid of their car? No, of course not. They vote for light rail because they think everyone else is going to take light rail to get rid of all these cars that are in my way, and I won't have rush hour traffic anymore. There's that difference between what people say and what they do. In their behaviors, there is no, what is that? There is no, Tina, there is no alternative. That's how, folks behave. I've met with pension funds in countries that are definitely not friendly to the dollar. The pension funds are denominated in dollars. They don't denominate the pension fund in the local currency. The local currency is toilet paper, and they know it. And they don't denominate it in euros. They don't denominate it in yuan. It's denominated in dollars. It has dollar investments all over it, all around the world. There really isn't any viable alternative. The network effect of the dollar is so strong that you could almost look at all the other paper currencies as like West Virginia coal mining towns with a company, scrip, or the other currencies versus the US dollar. There really is no irredeemable currency that can replace it. There is one thing that could replace it, but as I always say, ain't nobody want that. And that's that shiny yellow metal that nobody wants to talk about in that sense.
Yeah, and even the argument of, well, having a basket of currencies as kind of your new standard, it's all that's doing is diluting the legal strength of where you're putting your capital. I mean, going back to your point, the dollar's a reserve currency really because of the legal system and property rights, right, as opposed to anything else. And unless you have China as sort of the competitor, the real big competitor, having a degree of real framework around protection from Xi and other government officials, good luck. I mean, that's just not going to pass. But let me reset the room for the remaining 20 minutes here. Everybody, please make sure you follow Keith Weiner here on Twitter. And if you want to come up and ask questions, click that bottom left mic request button. You had mentioned unintended consequences. You don't like that term. You can argue there's a lot of complacency. I hear you on the nothing burger. They're going to pass the debt ceiling, all this stuff. But when you're in a very leveraged system, it doesn't take that many butterflies flapping their wings to create a hurricane. So it could be nothing, but right? I mean, that's the thing. It's this is what I think is being. That's why even this issue around sort of the Fed engineering a soft landing to me is problematic. They have to be far more precise today than Volcker was because the starting leverage of all this is so high. Right? Is there a scenario where this is no longer kind of a nothing burger? It's something that maybe nobody really sees coming at all when it comes to what's happening with the debt ceiling, where it could really cause either a 2011 repeat, something maybe worse, or is it just, like you said, something that doesn't really matter at all, and there's nothing that could make it matter?
I mean, there are political factions that are saying default, just burn it all down. Let's just get it over with now, and if that means mass death, so be it. I don't think those represent even 25% minority, let alone a majority. If those factions were to gain an influence and say, yeah, let's default, I don't think even those folks have really thought through what the implications of that are. But most people think of the dollar as having an independent existence from the treasury bond. And my argument is one's the front side of the bill and the other is the back side. They're one and the same instrument. The dollar is just a thin slice of the treasury debt. You default on the treasury debt, that wipes out all the dollars. So imagine everybody wakes up one morning and you don't have a bank balance because the bank is just, wiped out. You don't have a job because your employer's bank is wiped out. Even if you had a few paper notes in your pocket, first of all, nobody would take them. And secondly, the food stores, they can't buy any more, food because their banks were wiped out. That's a horrific scenario. I just don't think that's going to happen because I think the people that run the system kind of realize that and would overrule even if there was a political urge to try to default. But if that happened, I mean, then you're looking at, one hell of a crisis. And a crisis like that, I don't think it's about owning, anything that depends on electronics. People think about Bitcoin. I mean, the power grid's going to go down along with the food distribution system. So there isn't going to be computers in that scenario. You're obviously not going to be interested in stocks. I think those companies will all be destroyed as well. And what I always say to people when it comes to that kind of scenario is you're better off having gold than not, like gold in your pocket, but that may not necessarily avail you. And I distinctly recall seeing a museum exhibit. I don't know if this was the British Museum or an exhibit I saw in Zurich, but it was gold coin, gold hoards that were dug up in the post-war, building boom after World War II. There was a lot of taller buildings being built all around Europe, and in excavating for the basements and sub-basements, they unearthed all these treasure troves of gold coins that, in this particular exhibit, dated to the fall of Rome, to 476 AD. And some of these collections were, a few tens of ounces, and some of them were a few hundreds, or a few cases, a few thousands of ounces. These are very wealthy people that had a huge amount. I mean, 1,000 ounces of gold then, as now, was a fortune. These are very wealthy people, but obviously the gold did not avail them. That in the calamity and the chaos of what was going on when Rome fell, either these people fled with their lives and were never able to get back, or they somehow died either in the killing or in the long hard road, to get wherever they were going. And even the survivors, let's say you had an estate in what's now the south of France and you got out of Rome, you start to think, okay, well, I'll get back there when things calm down. But of course, they didn't. So you tell your kids, hey, we have a villa back in Rome, and in the sub-basement is this hoard of gold. And your kid tells his kid when he gets old, and, 3 or 4 generations in, it becomes the myth of Grandpappy's gold in Rome. And a few more generations after that, and it becomes, it's forgotten. And that's where it was for 1,500 years. So are you better off with gold in your hand? Yeah, it might buy you safe passage wherever you're trying to get to. But what a horrific scenario. And I think there's a lot of things I'm pessimistic about, but I'm not. I don't think that that's likely to come to pass. I think most people wouldn't be for it. And I think the people that run the system realize how bad that would be and would oppose it at every step. Yeah. So second part first. I'm interested in the commentary by Brent Johnson and by Jeff Snyder, both of whom I don't want to speak for them, but I don't think they're necessarily perma-bulls on gold. They're accused of being perma-bulls on the dollar, ironically. Brent with his milkshake theory and Jeff with his Eurodollar theory. But I think they have some very interesting things to say about, different aspects of the monetary system. What was your first part of your question? In general, I have a very different view as to what drives interest rates than probably anybody else. And in my view, you got to look at what's the demand. Who is rushing to issue more long dated credit at these rates versus liquidating capital to try to pay back debt. And so I just don't see drivers for a higher rate. I mean, could there be a short-term thing with the Fed's gyrations? If banks are forced to sell bonds and there aren't buyers, obviously rates can spike. On the other hand, with the Fed now essentially repoing all these long-dated bonds and doing so at par, it's a lot more attractive for a bank to repo it to the Fed than to dump it. And so I would tend to think that, we've seen the high in 10-year, yields on the 10-year, and the 10-year is wanting to fall in yield. not rise. I could be wrong on that. I'm certainly not a trader, but I just don't see the drivers for it.
You mentioned you're not a trader, but presumably, you'll also kind of either trim or reevaluate positions. I get the gold focus, obviously, but for your own personal portfolio, what are you largely doing, or what have you done, and what would cause some shifts?
I do have some long dated treasuries in my portfolio. Other than that, cash and gold, and of course, a great deal of equity in monetary metals, which that's what occupies my time and my energy anyway. But I don't really have much in the way of equities. There's a few things that I find interesting, unique situations, but I think we're in very perilous times, and I think far too many companies are either zombie or near zombie and are going to become zombies once all the zombies get liquidated, which I think is one of the things that happens in a rising rates environment. It'd be interesting to see how those walls of maturities hit. And now Bloomberg is starting to report on accelerated bankruptcy filings. We had an article yesterday. There were 7 decent-sized corporations that filed bankruptcy yesterday. And what does that do to all of their vendors and obviously all their employees and all the companies that sell to their employees? We're just getting started on that.
Have you seen an uptick in people that are interested in what you're doing with monetary metals and the interest side of gold, or is it kind of just kind of a gradual uptrend? I say that just to get a sense of sort of the pulse of people that who are familiar with you, if they're pulling the trigger on some of the stuff that you offer.
Yeah, there absolutely is. I mean, it's generally been an exponential uptrend since the beginning, and every time there's been a stutter or hiccup or crisis, there's an acceleration. So when COVID hit, that was huge uplift for us. I mean, it was awful personally to live through, and even in Arizona, which had a more mild lockdown than say California or New York. It's depressing to just see everything's closed, restaurants done, people not in the offices anymore and all that. But from a business perspective, it was awesome. And Silicon Valley Bank, same thing. There's a big uplift, for us in what we're doing, because it's kind of first of all, I guess it's gold, but I was going to say it's anything but the banking system kind of play. But I guess I wouldn't quite want to denigrate gold like that. It's more than just gold is anything but the banks. It's gold, and it's and what we're doing is we're making it much more of a mainstream type of thing that serves that function. That we're not a bank. We can't say the word bank. We're not regulated like a bank, but serves one of those functions, which is a vehicle for savings that has interest, which compounds, which is what since the beginning of time, that's what people turn to banks for, and now. For the longest time, post 2008, the banks weren't providing interest. Now they're providing some interest, but there's a greater awareness of the risk that comes along with that interest, which is massive and opaque and almost imponderable. What's going to happen with that? So yeah, there is a big swivel of attention to what we're doing.
Is the do you still think there's this kind of narrative of this competition of gold to Bitcoin and cryptocurrencies? That that narrative was out there for a while. It's like this battle between the two, and for investment flows, which I never myself believe that argument. But do you find that maybe there's more differentiated thinking in terms of either or?
Well, the idea that either one has to go up or the other, but not both, is just wrong at a mechanical level, right? Everybody who sells gold, there's a buyer of that gold. And everybody who buys Bitcoin, there's a seller of that Bitcoin, and the dollars are trapped in a closed loop system. So if the price of Bitcoin ticks up and you sell your Bitcoin, now you have the dollars. What are you going to buy next? It may very well be gold. We have any number of clients and shareholders who invested, in our equity, for example, with some of the winnings they had from crypto. So they're not mutually exclusive, even just purely at a mechanical level. I think the shine is off crypto. I think it's had this huge collapse, obviously from, what was that, November 2021. People, realize that it has this incredible downside. But I think they perform two different functions. So something that sometimes the crypto people try to say, gotcha, look at what Keith said. I would say crypto is obviously superior to gold at skyrocketing and also, of course, crashing, right? I mean, if your goal is to make 10x your money, gold is just not going to do that for you. And crypto might, but gold won't. So on the other hand, crypto can't finance anything productive in the real world. And that's exactly what we're doing with gold. So we've proven that gold can do that. It is doing it. And it's producing a sound and steady, return. Whereas in crypto, I used to say, there's no such thing as interest in crypto. Nobody can borrow it. And then, Keith, you're wrong. Look at all these crypto lending platforms like Celsius. Well, as it turned out, there was nothing sound about it. It was just all in on the Ponzi scheme. You call it borrowing, and then you basically buy more of the same. And as long as the price is going up, everybody wins. And but that's not finance of real productive things in the real world. If somebody gives us 100 ounces and we lease it to a refiner, we're financing something that's a real business that's serving a real market need. And regardless of whether the price of gold were to double to 4,000 or be cut in half to 1,000, the refiner has those ounces doing something productive with those ounces and is paying that return at the end of the year. You get back that 100 ounces plus, let's say, 3% if you have 103 ounces. So there's a soundness to financing real things that, crypto so far hasn't, really attempted to do, hasn't really entered the field. And I think people that are interested in monetary metals kind of realize that if there's going to be an end, and we're talking about this incipient crisis, it's the same as 2008, only bigger because they kicked the can down the road. The can has now grown, legs or arms like Trogdor. The can is kicking back or punching back now. What's the way out of this? We have to transition to another monetary system. The Bitcoiners would say Bitcoin, but Bitcoin can't finance anything productive. It's got to be gold. And, that's the why of monetary metals. We didn't just pick gold because we're betting on its price or its shiny rock or whatever. It's that, gold is the antidote. Gold is the only thing. It worked for thousands of years. It'll work again. And we need a graceful transition path to get there. And that's what interest is about. It's ultimately the regulator of flow of how something is going to circulate in the market. And if there's no interest, you don't really get, circulation. You just get hoarding. People buy it, wait for the price to go up, sell it, or get bored waiting for the price to go up, eventually sell it, or they sell to, cut their losses. You just have buying and selling, but you don't have actual circulation, which requires borrowing, lending, leasing, paying interest, and so forth.
For those that want to track more of your thoughts on markets, I think you mentioned your podcast, but for those that want to just get more involved in the way that you think about the world, or maybe learn more about what you're doing with earning interest on gold, where do you point them to?
Well, on Twitter, I'm at Real Keith Weiner, and the company is monetary-metals with an S, plural, monetary-metals.com. And we have a ton of articles on, how the system is failing, that it's going to ultimately be drowning in a sea of negative interest rates rather than hyperinflating with, skyrocketing consumer prices. But we've got a ton of stuff on that, and obviously about our products and how people can participate, and what's for general investors, what's for accredited investors only, all that stuff.
That's a good place to wrap this Twitter space up before my next call here. Everybody, please make sure you follow Keith Weiner here on Twitter. Appreciate those that keep attending these spaces efforts. I've got two more throughout the day, including one at 10 p.m. Eastern. So going to be a long day and night for me. Thank you, Keith. Really enjoy listening. I find myself nodding to a lot of things that you were saying throughout this conversation here.
Thanks for having me, Michael.
Thank you, everybody. Cheers.